Hello everyone, this is Shergill. So today I'm going to discuss chapter 5 for RIBO level 1 license. It's for regulation of insurance contracts. So a lot of provinces has similar regulation for property insurance, but the auto insurance is regulated by each province differently. Like BC, Saskatchewan, and Manitoba has public insurance, while Ontario, Alberta, New Brunswick, Nova Scotia, and Newfoundland have a private insurance, so they can have their own regulations. So, and there's the Insurance Act. Insurance Act. Uh, in this, you have to have the contents of an insurance contract, removal of coverage, limitation of liability clauses, right of subrogation, waiver of term or condition, effect of delivery of policy, policies ensuring the fire peril, basic coverages, standard exclusions, and statutory conditions. So, what covers the contents of an insurance? It covers the parties to the contract, like person insured and the insurance company. Policy period, mostly policy period is 1 year, but some companies or policies have 6 month policy period, even 3 months for some special risk. And insurable interest, like mortgagee on the home is have an insurable interest. Same way for car, you have a lesser, like leasing company or financing company have insurable interest. Type of insurance and amount of coverage, and rate and premium charge, and subject matter of insurance. So, so you have to go through these things. And removal of coverage. So many property policies restrict coverage on insured property to the location identified on the policy declaration form. Let's say if you are short of room at your warehouse or shop, you put the stuff at some different place, that stuff is not covered. So that's called removal of coverage. And a removal clause exception. One exception is that to better serve the public interest, the Insurance Act requires that property policies insuring against the peril of fire be extended to cover insured property if it must be moved to another location to eliminate or reduce further risk. Let's say if there is a claim or you have to move the property to a better location to eliminate the further loss, so that way that place is covered for insurance. And limitation of liability clauses. Most property policies contain clauses limiting the liability for loss to an amount less than the limit of insurance purchased by the insured. So, right of subrogation. It would go against the principle of indemnity for someone to profit from a covered loss by being paid twice for the same loss. So that means it should be a no gain and no loss. So company pays for what was the damage and to recover the damage and bring the thing back to the original position. So so that's the subrogation. So, and waiver of term or condition. All changes to an insurance policy must be in writing if they are to be binding on the insurance company. As, a, as set out in the Insurance Act, interim changes to a policy can be made only under the signature of person authorized for that purpose by the insurer. Effect of delivery of policy. An Insurance Act stipulates that when the insurance policy has been delivered but not paid for, it will be as binding on the insurance company as if the premium had been paid. So that's very important. So when you sign the contract with the broker and client agree to pay the money with the void check, so that policy is bound. So even if there's no payment came out, if there's any claim comes before that, so that claim will be paid. So that's why it's effect of delivery of policy. So, policies ensuring the fire peril. When a policy insures property against the peril of fire, the Insurance Act required the following three conditions. Basic coverage is fire, lightning, and exclusion of natural, coal, or manufactured gas. Fire is friendly fire and hostile fire. Fire contained in its proper receptacle, that is where it is supposed to be. If fire is a fireplace, like friendly fire is kind of fireplace, or within a furnace are example of friendly fire. Insurance companies will not pay for fire damage to property that was deliberately introduced to a friendly fire. Hostile fire, fire that escapes from its receptacle or originates outside of any such receptacle. Damage to flooring caused by a spark escaping from a fireplace is interpreted as its hostile fire. So lightning. Every policy ensuring against the peril of the fire must include coverage for losses caused directly by lighting. Losses insured within the peril of lightning include damage to chimneys, building, roofing, siding, fences, TV antennas, and communication towers. So, explosion of natural coal or manufactured gas. An explosion of natural coal or manufactured gas typically results in a fire. When insurance sells a policy covering against fire, these coverage requirements must be met. What are the standard exclusions? Standard exclusions are lightning damage to electrical device or appliances exclusion. Fire policy is not required to provide coverage for loss or damage to electrical devices and appliances caused by lightning or other electrical currents. Electrical currents other than lightning exclusion. Sudden surge or reduction in the power supply can cause substantial damage to electrical wiring and devices. If such damage is caused by artificially generated source of electricity, the loss is excluded. Contamination by radioactive material exclusion. When any of the perils insured under the policy cause radioactive materials to escape, any resultant damage caused by contamination is not covered. War exclusion is also not covered. Statutory conditions. Statutory conditions are set of policy conditions imposed by provincial legislation outlining the duties and responsibilities of both the insured, the client, and the insurer, means the company, under contracts of insurance. Accident and sickness insurance and fire insurance. Statutory conditions must be printed on every policy under their own clearly labeled heading. Because statutory conditions are imposed by provincial legislation, insurers are prohibited from making any changes to them. If there is a dispute about coverage following a claim, any variation to omission of or addition to statutory condition will not be binding on the insurer, even if the insured agrees to such changes. We will make a closer look at statutory condition in part 2 here. So what are the statutory conditions? Misrepresentation, property of others, change of interest, material change, termination, requirements after loss, fraud, who may give notice and proof, salvage, entry, control and abandonment, appraisal, when loss is payable, replacement, action and notice. So you have to make sure go through these all statutory conditions from your book, and misrepresentation is very important, and for material fact, and also material change is also very important, and effect of policy coverages and refunds and termination by insurer. So insurer can like insurance company can terminate the policies if those conditions are not met. And refunds. The rules regarding refunds are clearly stated in statutory condition 5 termination. When the policy is terminated by the insurer, refunds are on a pro rata basis. That means when insurance company cancel the policies, there is no penalty to do that. So they do it on pro rata. They only charge for the number of days the policy stayed active and return the remaining premium back. But if the client cancel the policy midterm, then there is a penalty, and it's called short rate cancellation. So the amount of refund due to the insured is calculated on a short rate basis. If client cancel the policy, if insurance company cancelled it, it is calculated based on the pro rata requirement after loss. So statutory condition 6 requirement after loss needs as follows. So upon the occurrence of any loss or damage to the insured property, the insured shall, if the loss or damage occurred by the contract, in addition to observing the requirements of the condition, forward give notice in writing to the insurance company. These days you can also call, deliver as soon as practical to the insurer a proof of loss verified by statutory declaration. And the evidence furnished under clause C and D of subparagraph 1, the condition shall not be considered proofs of loss within the meaning of conditions 12 and 13. Fraud. Fraud reads as follows. Any fraud or willfully false statement in a statutory declaration in relation to any of the particulars details the claim of the person making the declaration. Who may give notice and proof? Notice of loss may be given and proof of loss may be made by the agent of the insured named in the contract in case of absence or inability of the insured to give the notice or make the proof, and absence or inability being satisfactorily accounted for, or in the like case, or the insured refuses to do so by a person to whom any part of the insurance money is payable. When the insured is away or otherwise unable to provide notice and proof of loss, the insurance company is entitled to know the reason. If the insurer finds the reasonable acceptable under statutory condition 8, who may give notice and proof, an agent of the insured is permitted to fulfill these functions. When the insured refuses to make a claim, a policyholder who has deliberately caused a loss may refuse to make a claim if they become aware that submitting a proof of loss in the circumstance constitutes fraud and may result in criminal charges. Despite such a refusal, a mortgagee or other party with an insurer interest is generally entitled to collect in such instances and is permitted to file notice and proof of loss. So even when there's a fraud and client do not file the claim, the mortgagee can still file the claim because they have a right to claim. That's called standard mortgage claim. So even the house is burnt by the negligence of the client, still mortgage company will get their money from insurance company, even though client will not. That's next one is salvage. Statutory condition 9. Salvage reads as follows. The insured, in the event of any loss or damage to any property insured under the contract, shall take all reasonable steps to prevent further damage to such property, so damage and to prevent damage to other property. Salvage is a property remaining after loss that still has some value. Sometimes when there is like car is total loss, but even though they say car is write off, but still that car has some value for the parts somebody can use it. So, entry, control, and abandonment. It will be impossible for the insurers to determine the amount of any loss if its representatives were prevented from gaining access to the loss site. Appraisal. Most claims are settled with little or no disagreement. There are, however, times when the insured and the insurer cannot agree on the value of property involved in this loss. So, appraisal allows either party to ask that disputes involving violation be settled by appraisal, the details of which are provided in the Insurance Act. When loss is payable, this one is self-explanatory. The loss is payable within 60 days after completion of the proof of loss, unless the contract provides for shorter period. Replacement. It is very common for insurer to work with preferred contractors to perform repairs or reconstruct buildings. Most policyholders are content with this arrangement. However, they are entitled to make their own arrangement for such work with insurer appraisal. This is action. So, in other words, if an insured is unsatisfied with an offer to settle a claim, they may, under the fire statutory conditions, sue the insurer within 1 year of the loss or damage. So, notice this condition establishes the rules regarding all written communication between the insurer and the insured during policy period. Notice by the insured to the insurer. While most insureds will deal with their brokers for policy changes, they may decide to communicate directly with the insurer. All letters must be sent by registered mail or delivered to the chief agency or head office insurer in the province. Notice by the insured to the insurer. Insurer to the insured. Notice is properly given when it is personally delivered to the insured or sent by registered mail addressed to the insured at the latest post office address as shown on the documents. So to cancel the policy, company mostly gives 15 days notice. So this is the chapter 5 for regulation. So you can go through it and go through all the quiz questions like the one here. Like in Ontario, automobile insurance is regulated by the Compulsory Automobile Insurance Act. And in Ontario, which act contains the legal rules governing the operation of the insurance industry as well as rules applying specifically to insurance contract. That's called insurance contract. The Insurance Act requires certain mandatory details be stated within every contract of insurance. What is the portion of the policy summarizing this mandatory information? That's called declaration. Declaration has all those details. And which of the following party must be identified on an insurance policy as mandated by the Insurance Act? Insured and the insurance company must be written there. According to the Insurance Act, when does a fire policy expire? Policy expire mostly on 12:01 a.m. local time at the address of the name insured. So let's say if the policy is cancelling on November 1, 12:01 a.m. So that means on November 1, there is no insurance after 1 minute in the morning, 12:01 a.m. So many people confuse that they are insured for that day and policy expiring next day. When the date showing on the insurance policy that expiry date, that day they have no insurance. And to protect the insurable interest of others in the property insured, the law requires an insurance policy identify certain persons or entities, including all parties to whom insurance monies are payable following a loss, who would not be considered to have insurable interest in a policy of insurance. A person who expects to inherit property after their father's death. So they don't have insurable interest. So insurable interest is either by the insured or by the mortgage company or the lien holders. Which of the following statement is correct? The insurance rate is the cost of insurance per unit of exposure. There's another question. Michelia temporarily removes property from her insured premise to prevent loss or further loss from an insured peril. How long must be removal of property extension on the prior policy? 7 days. So that you can keep the stuff away from the your own property to save the further loss for 7 days. K moves his property to an unnamed location to prevent further loss or damage. Which of the following statements is incorrect? It must be shown that removed property was in danger of further loss or damage from wind or property. It must be shown that property was removed to an unnamed location because it was danger of further loss or damage from peril insured by the policy. If repairs to the location specified on the policy will take longer than 7 days, the policy must be amended to provide coverage at the temporary location, and the amount of insurance available for any loss to the property while at the unnamed location will be reduced by the amount paid for the loss at the named location. So this was chapter 5. I think you should go through it thoroughly. It was a big chapter. So I try to cover as much possible. So I will read the next chapter in the next video. So thanks for watching. So you can call me for any question at 416-831-0215, or if you want to get insurance or somebody looking to buy insurance, please refer to me. I'll really appreciate your support. So that will be a big help. So once again, please subscribe to the channel. Thanks for watching.